This is the Rocket City Retirement Show with Cris Wallace. Cris loves educating people in person and over the airwaves. Whether it's retirement planning, investing, tax, or legacy, Cris prides himself in helping protect what matters to you. This is the Rocket City Retirement Show.
Hello, I'm Luann Fulmer. Welcome to the Rocket City Retirement Show. I'm here with certified financial planner Cris Wallace. He is owner and president of the firm. Also joining us, certified financial planner Richard Constantine and financial advisor Graham Bauer. So we are excited to give you some great retirement planning advice. I want to start off with the phone number because if you have any questions, this is what you have to do. You have to give us a call, 256-937-2010. You can reach out to Cris. It's complimentary, guys. Now, you can also text the word VISIT to this number, 256-937-2010, if you prefer texting. And then check us out on Facebook, WG Financial Group 256. And remember our motto, everybody's motto, when you retire, it's this: plan and then retire and play. Find us online anytime at wgfinancialgroup.com. And oh my gosh, so excited to get started. Hello to you, Cris.
Hello, Luann. Glad to be back. We had a rerun last week, as I know a lot of people probably realize. So it's good to be back in the hot seat, if you will.
Yeah, back in the hot seat. Richard, you too.
Oh, I know. It's great. You know, last week, I wasn't quite sure what to do with all my free time. So
yeah, right. I heard about your free time. We'll get to that in a moment. And Graham, I want to welcome you as well.
Hey, Luann. Yeah, good to talk to you today.
Yeah. So, Cris, Richard was saying how busy he was last week with all those appointments because you were gone.
Yeah, that's what he says.
And it's true. You know, I've added a lot of notes to our system, so that they were booked. They weren't fake meetings.
Oh,
yeah, that's proof there. That's proof.
Awesome. Well, okay. We have to start off our show with some WG positivity. Graham, man, I've missed this. We haven't done this in a while. So what do you have for us?
Yeah, you know, I'll actually give Cris credit for this. He sent this article over to me. And, you know, I feel like I probably should have known about it as a big fan of the Olympics. But this one does come from the Olympics, I think it started back on Friday or Saturday, sometime over the weekend. We had the opening ceremony. And in 2 days from now, there will be a 20-kilometer women's race walking tournament, which I know everyone is very excited to see. Probably
a race walking?
Yeah, race walking. Yeah, so it's speed walking, basically. Yeah. Huh. But there will be someone who is competing for the first time in 24 years. She's actually 58 years old now. She competed for Team USA in 1992, 1996, and 2000, and then retired to homeschool her 5 kids, is now a grandmother, and qualified about a month ago to go race walk for Team USA. So if you, I guess by the time you guys are hearing this, it will have already happened because it's happening on August 1st, I believe. I can't find much other information about the actual race. I don't know how many race walking fans we have out there, but...
we have a lot, I'm sure.
Yeah, I mean, maybe closeted fans. They don't want to let everybody know how much they enjoy. But listen to this. I mean, she did a 12.4-mile race in an hour and 42 minutes.
And this was still...
race walking.
Race walking. Wow. Okay.
Yeah,
so they had it back then? I did not know that. Okay.
Well, that was just recent. That was about a month ago. That was her qualifying time. So she's moving quick. That's probably, I think that's faster than like my half marathon time, which is kind of embarrassing to admit because she's walking. But, you know, it's just another one of those stories that is good to hear that there are people out there getting into those retirement-ish years of their life. And, you know, we just like to highlight these things to show people that people still got a lot of life left in them. There's still a lot you can accomplish and a lot of fun to be had. And for her, a lot of miles to be walked, I guess, quickly.
Maybe a medal.
So, Graham, I think you're doing better than me. I would not say that she is walking faster than your half marathon time because I don't even have a half marathon time.
But Richard, you were the stolen.
You're doing well, man.
You were the stolen base champ in 2020 at WKU.
That's right.
Hey,
you're fast.
But you know that's a 90-foot sprint. You know.
Yeah. Yeah, it's true. So here's the deal. All right. So race walking, like if you don't do pickleball, I guess you can do race walking in retirement. Yeah. But here's what I envision, because I've never seen this before, race walking. I saw the article, sent it to Graham or whatever. But here's the deal. Like, let's say you've been out on a trip and you're almost home and you've got to go number one pretty bad, right? And if your bladder is anything like my bladder, the closer I get to the house, my bladder knows that it's almost home and it's like, hey, you better get inside quick.
Right.
So I imagine those race walkers looking like me going up the driveway with that little twisty rear end walk because I'm like having to walk really, really fast to try to get in because I'm about to wet my britches. That's what I envision race walking to look like. So I'm almost wondering if they just hold their, number one and, walk as quick as they can all the way through the track to get to the bathroom. And that's how they get a good time. I don't know.
I don't know about
Chris,
that.
Who walks faster, you up the driveway or an exhausted father trying to get out of Disney World?
Oh, it'd have to
Probably
be me
Chris.
if I've got to go to the bathroom. Ain't
If you're
nobody
exhausted,
stopping
you
me.
can't walk that fast.
Yeah, absolutely. So
Oh my
anyway, that's the
gosh.
way I envision race walking.
Oh, I think you're right. I really do. That's funny. Oh, wow. Well, pretty cool. Thank you for that story. Love that. Love that.
Great story.
Mm-hmm.
Even
Always.
including my race walking.
Even your story, Chris. Yes. Okay, so let's go ahead and get into what's going on market-wise. Chris, tell us, sorry, not Chris, but Richard, I'm going to direct this one to you. Tell us what you've been seeing, what we need to know about the markets.
Yeah. So, first off, overall, all indexes are positive on the year. What I mean by that is S&P 500 is up 13.57%. The Dow Jones is up 7.86%. The NASDAQ is up 14.52%. And even the aggregate bond index is now up 0.21% year to date.
Wow.
So I think it's the first show we've actually been able to say that. But, as we have seen in the last really week and a half now, almost 2 weeks, there has been a lot of negative volatility or price action in the market. This will actually be the first month of July in the last 10 years that the S&P 500 is going to be red overall in the month. Currently, it's trading at down 0.8% month to date.
Mm-hmm.
If it does not rally in tomorrow's trading session, then, like I said, it will be the first red month of July in the last 10 years, which is quite surprising to me. And another interesting thing that has happened in these past 2 weeks is the S&P 500 had its first negative 2% day in the market in the last over 500 days since 2022. And so, it's just one thing that we want to remind clients and listeners alike is, we're seeing all this negative volatility in this past week and a half, 2 weeks. The first red July in 10 years, the largest single day drop in over 570 trading days. But if you zoom out and still look at the year to date returns, everything is still green. And so one thing that we want to remind people is that this is a long game. It's not a get rich quick entity.
Yeah. When in doubt, zoom out, right, Richard? Just kind of
Exactly.
like what you're saying.
Exactly.
I can't take credit for that. I saw it somewhere. I might have saw it on Twitter, which is X. Do you call it X or Twitter? What do you call it?
It depends on if I'm trying to be proper or not. If I'm talking to a friend, it'll be Twitter, but some other people will be X. So.
If you're talking to Elon, you're going to call it X.
Oh, yeah.
Oh, absolutely.
Yeah. Okay. That's what I thought. So any more thoughts on what's going on today? There's a lot of stuff happening.
So the rest of this week is actually an incredibly big week. We have 40% of the market weight or the market cap of the S&P 500 reporting earnings between Tuesday and Thursday of this week. We have Apple, Amazon, Facebook - Meta, and also the FOMC. They're going to announce their interest rate policy for the month of July, Wednesday, July 31st. And so there's a lot of things going on right now.
Are they dropping rates, you think?
I do not think they'll drop rates yet, but
Negative.
I expect
That's right.
I expect them to provide clearer guidance than what we've seen previously on when it will actually happen.
Mm-hmm. It's coming.
It is.
It's coming. As of right now, the Fed fund futures are saying, as of today, I looked before the show, the data is telling us that there is an 85% chance of a 25 basis cut in September. So it's coming. And so, like, what does that mean? Well, it just means that the saver who has been benefiting from these higher money market rates, these higher CD rates, these higher annuity rates, those rates are going to start to creep down. I know that we're in the insurance business for part of what we do. You guys, Graham, Richard, know this because we get emails almost on a daily basis right now because of where the 10-year Treasury has dropped to, the 10-year Treasury yield. We've gotten several emails letting us know rates are dropping. You're going to see that across the board in all these fixed income type products.
Well, and Chris, right now there is $6.14 trillion worth of funds sitting inside of money market accounts.
Mm-hmm.
Once rates start lowering, those funds are going to have to go somewhere.
Yeah. And it's hard for people to move out of that. Even if rates drop into 2s and 3s, you're still going to have a lot of people sitting there saying, well, it's not the time. It's the other shoe's about to drop, or this is going to happen. The dollar's going away. The United States has fallen off the, face of the earth, or whatever. It's like we've said before, when you're getting out of the market, you have to be right twice. It's that second twice, that second right that you have a problem with. And we liken it to, when spring comes around and you're wanting to get in the pool and you're like dipping your toe in, and it's like, it's cold. I don't want to jump in just yet. And, you never get in until later on. And then, the reality is you probably should have gotten in before. So there was a couple other things, Richard, I want to mention here. You had mentioned something in pre-show about Meta. So let's just go ahead and talk about Facebook Meta real quick, because I know you want to blast me on air. So let's bring out the guns and let's do it.
Well, no, I mean, it's just something that we've talked about frequently, or not frequently, but a few times previously on the show, about how Facebook, or Meta, is the only company in the 20 largest S&P 500 companies who have not split over.
Mm-hmm.
I've heard significant rumblings that there is a good chance they will cut in their earnings call later this week.
That they're going to split.
Oh yeah, exactly. Split. Yeah. Not cut, split.
Yeah. I knew that's what you meant. Yeah. I think just based on a couple of things that I read since you pointed it out to me, that it's looking very likely, because the price where it is today per share supports that. And so, yeah, I think I'm kind of in that split camp too. I think that they'll end up splitting as well. So,
and also, and I don't know the specifics, but typically CEOs, CFOs, and other high-level executives have compensation plans in place that reward them for well-performing stocks. Just look recently at how NVIDIA reacted after their price split. Look at other large tech players who have either announced a very small dividend or a stock split, and how their prices adjusted quickly. And so I would not be surprised if it happens soon.
Yeah, I agree. I want to switch gears to Social Security COLA for 2025. So just doing a little research on that. So like last year's Social Security cost of living adjustment COLA was 3.2. And it's looking like, with the latest round of inflationary data that's come out, that 2025 is looking like maybe 2.6 to 2.7 as it sits today. So for those of you who are taking Social Security, or if you're 62 or older and not taking Social Security, you also get the COLA as well. The COLA right now is looking like somewhere around the 2.6 to 2.7 range. One of the other things that I saw, I happened to see this online, I think it came from Bloomberg, that 39% of homes in the U.S. don't have a mortgage. So for me, that was kind of a shockingly high number, because that's nearly half at this point, and that's up from about 34% in 2012. Actually, frankly, I'm surprised that in 2012 it was as high as 34%, but now it's 39% of the homes that are out there don't have a mortgage. So I thought that was kind of unique.
Are you saying they're paid off?
Yeah, exactly.
Yeah,
they're paid off. Yeah. So nearly half, the homes are going on, half the homes in the U.S. don't have a mortgage.
Wow.
And I guess with rates as high as they are right now, you're going to see those people just continuing to sit on those. Mm-hmm. I would also argue that the reason for that is you've got a lot of the baby boomers that are retiring, and the majority of them have paid off houses. Right. So, you got like 10,000 baby boomers per day retiring or something along those lines. The majority of them have paid for houses, which probably account for a lot of that number, I would have to imagine. Mm-hmm. So, and I want to talk about a real quick story here. One of the cool things that, Graham, Richard, myself, my staff, everybody at the office, one of the cool things about working with individuals and families is you get to see kind of firsthand the fun things that they're doing. So, one of my staff members, her name is Casey. She came up with our motto. It's plan, retire, and play. And I think that's just awesome because, if you do your proper planning and you move into retirement and you've done proper planning, then you should be able to play and enjoy retirement. So we do encourage our retirees to go out, do things. We love it when they take pictures and send us pictures either via email or via our compliance approved text line. They'll send them in there. We like to put them in our newsletter. So it's all really fun. But here's kind of the crazy thing. All right. I have this one, he's been a client for a long, long time. And he lived in Huntsville and then moved out of state. And I was doing reviews with him, and I get a call from him one day and he says, "Hey, you're not going to believe what we're going to do." And I was like, "Okay, well, what is this?" And so he basically says, "Hey, we're going to retire, and we're going to retire soon because you said we can, and we're going to live abroad. We're going to travel in South America, and we're going to live cheaply there." I'm going to mispronounce this name, but it's Querétaro, which is in Mexico. He said that was one of the first places they were visiting. I said, "Oh my gosh, that's crazy. I know where that's at." He said, "No, there's no way you know where that's at." I said, "Yeah, in manufacturing, we actually had a facility there. I've been there." So that was kind of funny. Wow. So they were visiting places in Mexico and South America, and, they're going to live abroad, and that's what they were going to do. So this is about a year ago. So he came back into town to see, I think, some family here. And when he came back, one of the things that I find out is that not only are they living abroad, they are actually house sitting. Oh. And so they don't really have a place to live per se. They sold their house and they're literally like living the dream, if you will. Oh. But they're going to different countries. So they're like house sitting in Mexico, and they're going from house to house sitting. And they're about to go over to the UK and do that. And they're even doing it some here in the United States. And listening to this story and talk about this was just, I was in awe. Like my jaw was on the table. I was like, "Oh my gosh, I can't believe this." Now, I couldn't do that, but kudos to him for doing that so that I can kind of live that experience from the outside without having to, worry about certain things. But he and his wife are enjoying it. They're great clients. And it was so awesome to really get to see him, because she didn't come to the meeting. She wanted to go shopping. And I told him, I said, "I can't blame you or blame her. You've been out of country, and for you to come back and get to a shopping mall or whatever and eat at a restaurant maybe that you want to, I don't blame her for not wanting to come talk about money. Go do your thing or whatever." So anyway, so that's kind of fun.
I've never heard of that. How did they find out how to do this house sitting thing?
Yeah, I think they kind of stumbled into it. They also, they kind of stumbled into it. They also talked about some ministry type stuff that they've kind of stumbled across during this whole process, and just kind of being spirit led or whatever. And it's just really, really, it was a very cool meeting. So as an advisor, that's one of the cool things that, that we get to do is we get to live that experience, somewhat vicariously in some cases with some of our clients. So I thought that was kind of cool.
Do you know if they have to take care of like pets or anything for the owners?
Oh, okay. Is it that kind of house sitting? Yeah. Okay.
Yeah. Great question. Because the last place I believe was in Arizona, which was near the wife's mom. They were taking care of a couple of dogs is what he told me. So yes, they are doing some house sitting / pet sitting.
That would kind of scare me. Not necessarily from staying in the house, more so taking care of the dogs. If someone's letting you stay for free and then I accidentally kill your
the dog.
Yeah.
Especially in another country. Yeah. You might get deported back to the US or something.
Or not.
Yes. No, but that's really cool though. That's takes a lot of
guts.
I was going to use, I guess, the word more whimsy, I guess, do that. But you're right. Guts too.
Well, there's some other words you can use too, but we won't say those on the air. But so let me just talk about a couple of things here. So we've had a little fun here early on. And, I just want to talk about the latest round of current events that's happened over the last several weeks. So we've had an attempted assassination, which was kind of nuts. It was really nuts. Joe Biden dropping out of the race. That was kind of crazy. Yeah. I think a lot of people expected it. Mm-hmm. The market hasn't been super kind. Richard kind of went over that. The July's been a little bit volatile. And then we had all the craziness around the opening ceremonies at the Olympics. And, right now, I think what we kind of feel from just people in general is that emotions are running pretty high. And I think it's going to remain that way for the next several months. So I think, emotions are running high. We're looking at the presidential race coming up. And, again, just hello, spoiler alert, emotions are going to run crazy for the next couple of months. But here's what I want to do. I want to challenge, and this is what I do for myself. I want to challenge the listener to ask themselves 2 questions. The first question is, am I placing too much faith in man and not in God? Period. So like if you're looking at the presidential election, I don't care what side of the fence you're on. If you're listening to the show, I truly don't. But I want you, if you're all concerned and upset and, just getting all emotional about it, you just stop right what you're doing and ask yourself, am I placing too much faith in man? That's question number 1. Number 2 is, if I have a retirement and income plan, why am I worried about all of the market volatility and all the craziness that goes on around me? You've heard me say it for many, many years on the air. And we Luann, you and I, we talk about the importance. We've been doing this for almost 8 years together on the air, the importance of building a retirement plan. So why is this necessary? Because I've said this 100 times on the radio. You're going to feel different emotions when you're in retirement. You think all of these current events are making you crazy and emotional? Just wait until the market drops 10 or 15% when you don't have a job, coupled with all of these crazy events politically. The way that you view the market and the volatility is going to intensify for most of you. Concerns about your health care are going to crop up. Dealing with the loss of a spouse is likely to happen. Do I have enough money is going to cause you to sit on your retirement assets at a time when you should be going out and doing the things, they call it the go-go years, but going out and spending that money and doing the things that you should be doing early on in retirement when you're much more mobile. All of these emotions are going to cause a lot of these things, to happen internally. So does having a plan get rid of these feelings? I mean, not really, not completely. But we believe the families that we serve are able to approach retirement with more confidence because they have a design plan that will allow them to spend and enjoy the fruits of their labor that they've put in over the last sometimes 20, 30, 40 years. So what does a plan consist of? So I want to talk about that. So I think basically, and Richard, Graham, you guys feel free to chime in on any of this stuff, but I get the feeling when I'm meeting with people that they only look at their retirement assets as their plan. In other words, they pull out the 401k statement or the IRA statement or whatever, and that's their retirement plan. But we know as a group that retirement plan consists of a whole lot more than just that. And I can tell you that the vast majority of people that come to our first meeting, they understand the depths of how we look at planning and what we look at, the questions that we ask. It's bigger than your statement in most cases.
Yeah. I totally hear that. And I've definitely seen that with people. One thing, I guess, kind of like a term that gets used sometimes in financial planning is mental accounting, where you're kind of not looking at all of your accounts as your overall portfolio, but looking at them as your individual account. So, say you got a Roth IRA, a traditional IRA, a annuity, a non-qualified brokerage account, all these different accounts. And you might see one account go down a little bit in value and start freaking out that you're going to, oh no, I'm starting to lose some money. The market's pulling back, and not take that broader look to look at your whole portfolio, and even beyond your whole portfolio to, look at your income and say, what do I have coming in? So I think that's one of the easiest traps to fall into is to, go on Google and look up one login, and that login maybe you get to see a couple accounts. It doesn't show your whole financial picture. And based on that, you can end up kind of freaking out. I was talking with a couple clients yesterday who he recently retired, probably like 3 weeks ago or so. And his wife so far has been a little bit stressed out about it. Even though their financial plan looks great, they have a lot of money. They had, saved really well over the years. And, we were kind of going back and forth because they were saying, oh, I don't really know if we need to start taking distributions right now. We got a lot in savings, but, I could just tell that the wife was very stressed about the fact that they were spending down their savings, and they had plenty of savings to spend down, but that's not really the point of it. So we kind of eventually decided that we're going to start doing some distributions, just small ones on a reoccurring basis, really just so you don't have to constantly watch your savings get smaller and smaller. Occasionally, every month or every other week, they're going to get a little bit bigger just to kind of show you have other money. This account is not all of your money. You haven't started your Social Security yet. Like, this is not what retirement is going to feel like for the rest of retirement. But I think how you start is important. And so if you start in a place of stress, you might always stay in a place of stress, which is not where you want to be, especially for people that have the assets, have the intelligence and the plan behind them to know that they have enough. Yeah,
even if even if you have the intelligence, it's kind of like I was saying, you're going to experience those emotions. And you mentioned retirement income, and that's part of a financial plan. That's really the basis of your retirement plan is, building a sustainable and predictable income plan, and know how to take income in the most tax efficient way possible. You take a look at your investments and insurance. It's important that you ensure that your investments are set up to last as long as you do, and also do that in a cost-effective manner. We've seen other individuals and families that have come into the office working with other advisory firms, and they're paying way too much in fees. Their expense ratios are way too high, and that's where we offer an analysis to kind of really dig into that. I've also seen where advisory firms will blend in, kind of figure out like an average fee that you're paying if they use an annuity that has no fee. So they try to tell you that, okay, well, you're only paying us like 0.8% because, they're taking into account the annuity has no fee. And in reality, you're probably paying 1.5% on the investments, which is astronomically too high. And so this is why we encourage people to come in for a second opinion. We encourage you, if you're going to ask us, what do you charge? You should probably ask your current advisor before you come see us what they're charging you, because what we find is most people have no idea. So, again, talking about the financial plan here, we got the insurance that includes Medicare, life insurance, annuities, all of those things, long-term care. And then really, I think where we excel is in the tax efficiency of things and recommending when is the right amount to Roth convert, when to do that, how much. And then also even pre-retirement, a lot of our clients are still working and they're needing, help determining where to save money in the most tax efficient manner. Now, we're all going to pay taxes at the end of the day, but really the question that needs to be asked is, if I know there are ways to reduce my tax liability to the IRS, why would I not explore those options? And I think that there are people out there today that are listening to the show. They're just accepting the fact that they're going to pay taxes, and they're not really, sometimes you don't know to ask these questions, but we can tell you from experience that I won't say every client, but I can say a lot of prospects that do come to see us, we're able to point them in a direction that would make their situation a little bit more tax efficient. And then lastly, we talk about estate and legacy planning. The Secure Act laws have been changed. They were changed, several years ago. So, do you know what that looks like for your family when you pass away and what they're going to have to pay in terms of taxes? Do you know how they're going to have to take money, out of those accounts? Do you have a plan to offset those taxes on your estate if you're at that limit? What if they drop the estate tax limit way, way back? Is your estate, in trouble? Now, we don't place a dollar limit out there for people to call us. I would say that a lot of our clients have, higher balances because of the type of planning that we do, but we don't discriminate. If somebody has, $250,000 and they need help, then it is what it is. We don't turn anybody away. We talk to everybody. We try to offer the best advice that we can for those individuals and families. And if you would like to set up a discovery session, you can do that by giving us a call at 256 937-2010. I've been out of town, Luann, and I almost forgot the phone number. 256-937-2010. Give us a call for your discovery session. We'll be glad to sit down and really go over your situation. We don't do gimmicks. We don't advertise free reports. I don't tell you to come to a workshop. Come in. Let's dissect your retirement situation so that we can help you and your family build out a plan. 256-937-2010.
Have I saved enough? Will my retirement last? If these are some of the questions you may have, it may be a good time to set up a visit with Cris Wallace. Just text the word visit to 256-937-2010 to schedule a meeting today.
Quarters, just 25 cents. That's hardly anything, right? But Cris Wallace and his team at WG Financial see quarters a little differently. A quarter is a lot when it's a quarter of your retirement savings. Now, do you want to pay 25% or more in taxes during your retirement? Well, Cris can create a plan to help address that. Now, if the only time you think about taxes is when you file them, you don't have a tax strategy. But it's not too late to get one with the help from Cris Wallace. So act now to make sure you're not paying a quarter, dime, or even a penny more than you should. Call Cris Wallace and his team at WG Financial at 256-937-2010 to schedule your personalized tax strategy session. A quarter saved is a quarter earned. Call 256-937-2010 now. That's 256-937-2010. Investment advisory services made available through AE Wealth Management, LLC, a registered investment advisor. Firm may not give tax advice.
Navigating uncertain times in the volatile market? Don't make impulsive decisions. WG Financial Group is here to help you plan, retire, play. Call now at 256-937-2010. That's 256-937-2010 for advice you can count on.
And if you'd like to text the word visit for that same thing to get on their calendar. The discovery session is complimentary, 256-937-2010. Just head to WGFinancialGroup.com, even more information there. Find out about Cris and our awesome team here with me today from WG Financial Group. So thank you so much for joining us. This is the Rocket City Retirement Show. Our show is available on Spotify and Apple Podcasts. Just search for the name of our show, and you can listen to past shows that we've done. So thank you so much for joining us. And now we're going to kind of move into another area. You know, so many of us have our savings in a tax-deferred retirement account. And so you might want to be aware of some of the new retirement planning rules that have actually changed the way we need to think about these tax-deferred retirement accounts. And, you know, Cris, you just mentioned the Secure Act and Secure Act 2.0. They could have an even bigger impact on those people with balances of $250,000 or more.
Yeah, they sure can. And I was just kind of thinking about, I mean, if you just like look at the normal, I guess, working population out there today, most people have a tremendous amount in pre-taxed accounts. Really, one, because the Roth wasn't introduced until the late 1990s. But even at that, I think it was around the middle 2000s that the 401k, you were able to put in Roth. And then there was the whole trust factor, right? Like you didn't really understand it. It's like, okay, what is Roth and should I do more? Now you're sitting there today going, man, I wish I'd have put all my money in Roth at that point, if knowing what you know now, because there's just a lot more information that's available today. But there's a tremendous amount of money in pre-tax accounts. And then, with the Secure Act laws that changed, that moved the RMD age out to 72 to start with. If you remember at the end of, I think it was 2019, the first Secure Act 1 was signed into law, and it moved that RMD age out to 72 from 70 and a half. So I was like, okay, cool. You get another year and a half of whatever relief. Well, the other thing that was done in that Secure Act law passage was the non-spouse beneficiary now has 10 years that they have to empty out the IRA. And let me remind you that goes for Roth IRAs as well, because I've had like engineers come in to talk with me and they have, big pre-taxed IRAs, 7 figures in a lot of cases. And they're like, hey, I'm just going to Roth convert everything. that way my kids don't ever have to pay taxes. And that don't ever have to pay taxes, part of the comment is true, but they still have only 10 years to let it sit in the Roth status. So let's say mom or dad passes away, they leave a big IRA that's all Roth. Well, you can leave it, you can set up an inherited Roth IRA, and then you have 10 years to leave it in Roth status. And at the end of the 10th year, you have to pull it out. Now, there'll be no taxes due, but you have to pull it out of Roth status at that point.
Oh, okay.
The IRA, on the other hand, you got 10 years to pay the taxes.
Right.
And so there's an issue there with, potential tax liability. So there's a ton of money. I'm sure we could probably Google and find out how much money is in pre-taxed accounts, but there is a lot out there, which is a lot of tax liability for families and beneficiaries, off in the future if nothing is done about it.
Well, and I think the other thing, to your point about the inheriting the Roth IRAs for beneficiaries, especially if you have younger kids that are going to inherit that, they have 10 years where it can be in Roth. And after that, they're going to kind of have to figure out what to do with that money because, they can be taking distributions, but if it's a very large IRA, they're not going to be able to recontribute all of that to Roth because they're subject to those annual limits, which they'll probably be well over. So, I think that's another important reason if you're doing that, why it can be a good idea to have your kids involved a little bit in your financial planning if you want to. And there have been plenty of times where we've talked to people either as a family with everybody's consent or, had separate meetings with their kids to kind of help them get started on the right track. Because if you're going to leave your kids a lot of money, it's probably also wise to leave them with somewhat of an idea of what to do with it, at least with helping them get some financial literacy before they come into all of that.
Yeah, I think the other thing too, Graham, to your point about leaving money to the kids is more than likely when mom and dad pass away, let's just say that they're in their 80s, more than likely their kids are going to be in their early, mid, or latter 50s. So they're going to be making probably the most money that they've ever made in their life. They're going to be in what we call the peak earning years. So you've got, someone, let's just say you're making $200,000 a year. As an individual, maybe your spouse is making another 200, you're $400,000 together between both of you. And then all of a sudden you got to start thinking about taking distributions from an IRA. Now, if required minimums have already started for mom and dad, which at age 80 they would have been, then the kids have to continue taking those RMDs as well. And so again, just kind of adds, or to the point of it just adds more income to their tax return. So, and I get it, like they didn't work for the money, and if they have to pay higher taxes on it, then it is what it is for some people. But the reality is it's really going to probably push people up in a pretty high tax bracket when we talk about the beneficiaries.
Yeah. So obviously nobody wants to leave that hefty tax bill to their loved ones. So Richard, why don't you, if you can, please give us some strategies on how we can minimize that tax burden of inheriting an IRA?
Absolutely, Luann. And, fortunately, there are a few different routes that you can go. The first route is, like Graham and Chris alluded to, if you get the whole family involved in planning sooner rather than later, you can start doing some Roth conversions, and you can actually see how big of an impact it can make, because now you're not just running off the timeline of your own life expectancy. You're now running off a timeline that's 10 years extended, which, the real benefit of Roth converting is to leave the funds in that account as long as possible so they get the largest amount of growth that you can in that account. And, Luann, another option that you can do is to open up a CRT, which is a charitable remainder trust. And therefore, you are spreading out the distributions over a little bit longer time as well.
Okay, awesome. Well, thank you for that. So before the Secure Act, just kind of going back in time, people who inherited an IRA could spread out those withdrawals for a lifetime. Wasn't it called the Stretch IRA or something like that?
It
Chris?
was.
Yeah.
It was. I want to just touch back on something Richard said. So, basically, as the Secure Act rule, and we talked about this actually on one of the more previous episodes. So you've got 10 years with pre-taxed accounts where you've got to empty the account out. And when it comes to, he mentioned a CRT, so a charitable remainder trust. So that's another way, especially if you're charitably inclined, even if you're not charitably inclined, but you lead with charitable intent, then what you can do is set up a charitable remainder trust post-death with an IRA. And with that charitable remainder trust, what Richard was explaining there was you can actually stretch it out for up to 20 years. So you get double the time frame. And you might sit there and you go, well, 10% of that's got to go to a charity and I really want it to go to my kids. Well, if you have 20 total years to take the withdrawals and you factor in growth over 20 years, your kids are probably likely, with the compounding over 20 years versus 10, probably likely to get more. And they're able to stretch that out over the 20-year time frame, which will likely result in lower taxes as well. So that was a good point he made there, that is an option for especially like larger IRAs that you're not going to get it all converted, because some people, they have so much money in pre-taxed accounts. I mean, again, we work with some pretty large IRAs, and in some cases it is very, very difficult to get those all converted over. So you're going to either leave the kids with all of that money where they've got to empty it out within 10 years, or you can take a look at a CRT, as Richard kind of mentioned.
All right. So, Graham, why don't you explain how these new laws then could affect retirement and legacy planning, please?
Sure. So, we used to have the stretch IRA, as you guys mentioned, which was kind of what it sounds like, stretching the withdrawals over the course of the lifetime of the beneficiary. And with the Secure Act 2.0, it took that away for most non-spouse beneficiaries. But there are a few exceptions that I wanted to go over quickly because it doesn't necessarily apply to everyone. So a surviving spouse will have a couple of options. And, it's definitely good if you're in a situation where you lose a spouse and you want to see what the best option is for you, because you can obviously roll it into your IRA. And at that point, it's going to be subject to your RMD table once you get there. Or you can do an inherited IRA. And I know you would probably ask, why would I do that? Because then I have to empty it out in 10 years. Well, you probably wouldn't do it if you knew you were going to, have 10 years until you reached age 59 and a half, and we're going to have to take in all this income. But if you're retired, before age 59 and a half, and don't have access to a lot of pre-tax money and qualified funds that you would need without penalty, it could be an option. And that is a scenario where we've actually had a spousal IRA or I should say an inherited IRA by a spouse done as an inherited IRA initially for the first couple of years to supply some extra income and some extra liquidity that they wouldn't have if they rolled it into just their IRA immediately, because then they would be subject to that 10% withdrawal. There's also an exception for someone who is not more than 10 years younger than the plan participant. So if your beneficiary is less than 10 years younger than you, you're kind of considered in the same generation. So they also do fall under the stretch IRA rules. And I don't believe they actually have to be related to you. It seems like that was kind of a concession that they gave for, changing the rules. Again, that's not something very common to see for a non-spouse, but some people that don't have kids might have, a brother or a cousin or something as a beneficiary, and that would be another exception. There's also a minor child, and that exemption for the stretch rule only applies until they reach the age of majority, which can vary from state to state. But if they're still in school, I believe you can stretch it all the way up to age 26. And then at that point, the 10-year rule will apply. So they can take the smaller distributions at first. And then the last one would be a disabled or chronically ill person. So if they fall under the definition of disabled, then they're able to use the stretch IRA rules. One thing to note about that, and I am not going to pretend to be an expert on this at all, but if you do have a special needs trust that is set up to inherit an IRA, it would be good to have that looked at by an attorney to see how exactly you've set it up, because there's a few different ways to set it up that could affect how those distributions have to be taken. So for tax reasons, we would probably recommend you talk to an attorney about that, as you might want to do for any trust that you set up before the Secure Act 2.0, because there were some laws changed about trusts inheriting IRAs.
Actually, would be before Secure Act 1.0.
Oh, before 1.0.
Yeah.
Yes.
So if your trust was set up before the end of 2019, you should contact your attorney, especially if the trust is a beneficiary of your IRA or 401k, to make sure that your trust is still valid. And my guess is it's probably not, because the laws probably changed. But yeah, good point there, Graham, for sure.
Yeah, get a second set of eyes. And if you would like to have WG Financial Group be your second set of eyes, all you have to do is call this number. We give it out every week on our show. I bet you have it memorized. But if you don't, 256-937-2010, that's the number to call. Or text the word visit, same thing, get on their calendar, 256-937-2010. But, that's why we do this show every single weekend, to get your questions answered. If you have more, if you want to go in for some more detailed conversation about your own personal situation, certainly go see them. These guys that you're listening to today, Chris and Graham and Richard, they would love to meet with you. They're passionate about helping retirees and helping you make your plans for retirement, so you can plan, retire, and play. You're listening to the Rocket City Retirement Show. Remember, WGFinancialGroup.com is the website as well. So, all right, we're talking about, what to do with those large IRAs. And of course, converting to a Roth IRA means paying taxes at the time of that conversion. So, Chris, walk us through how you talk to people about strategies. How does it go when you're trying to help them lower their tax bill, if possible?
Yeah, how does it go? Sometimes good, sometimes it's a tough pill to swallow.
Aww.
When you start talking about converting, and you pitch around numbers 20, 30, sometimes much larger than that, depending on the amount that you're converting. It's, for some people, it's a very heavy, large pill to swallow, that tax pill to swallow, because you're thinking, oh my goodness, I've got to pay an additional $40,000 to convert this. Yes. But the idea is you're going to pay 40 today versus tens of thousands of dollars over your life expectancy. So when I'm talking to clients about what to do, how to do this, why we should do this, it's about the long-term outlook and picture, just like you are for the stock market. We know that we don't invest in the stock market to make returns in 1 year. We're looking at a much longer time horizon. The same thing for a Roth conversion, because ideally you want to convert. And if it's me, you want to convert earlier than later, because I think, the older you get, and when I say the older you get, north of 75, 80 years old, at that point, does it really make good sense to convert large chunks at that point? Because you do need time for, those Roth balances to kind of build back up from where you've paid the taxes on them. But for the vast majority of people that we work with, it makes sense. But again, swallowing that tax pill today is difficult for some people. They don't want to do it. That's really the main thing. They don't want to do the conversion today. So really what we try to do is talk about the long-term effects of it, and how, it's going to help them within their own financial plan, but then also for the kids and non-spouse beneficiaries and even spousal beneficiaries that are going to inherit this money. It puts them in a better position. So I just mentioned spousal beneficiaries. So let's just take, for an example, husband has, let's say, a couple million in an IRA, and he hands that off to the spouse if he passes. What I think a lot of people tend to forget is the spouse, the surviving spouse, is now going to be in a single filer tax bracket. So they get, they get it a lot worse in the single filer bracket. There's just not the same amount of room when you have the joint filing brackets. They're just larger, obviously. So you do have to think about that as well, because now all of a sudden, you're going to have to pay taxes jointly, right? And unless you convert. But then when you pass away, that single filer, that tax obligation is going to go way up, because we're going to assume that the balances are going to continue to grow, which means the RMDs are going to continue to grow. And then ultimately, for a lot of individuals, that's going to hit the IRMA limits, which means your Medicare premiums are going to grow. And, kind of as a reminder, those IRMA premiums, those Medicare premiums are pulled out of your Social Security. So it's an excellent way for, I don't know if this is by design, I'm going to assume it probably was, but it's an excellent way for the government to reduce your Social Security payment, because you're paying more in Medicare premiums because you've busted through the IRMA brackets, as we like to call it. So there's a lot of really good reasons to really strongly consider Roth conversions. But again, a lot of people just don't want to pay the taxes today. But if you do the numbers over 15, 20, 25 years, you're going to pay a lot more in taxes if you do not do some conversions today.
So, Chris, do you do something like a Roth conversion analysis for people?
We do. We have actually a couple of softwares that we utilize to kind of hone in on how much we should convert. I can tell you that a lot of our numbers will tell you just go ahead and eat the big one over a few years and get it over with. And then you've got time to recover because, depending on where you are. So we work with a lot of retired military. We also have a lot of retired federal government employees. So they have, especially if you were military and a federal employee, now you have a retired military pension, then you also have a FERS pension, and then you have Social Security. You have a lot of income. So you have very little room in the 22 bracket. So a lot of times you're converting up into that 24. Well, you go over in that 24, that's the first couple of IRMA brackets there. So, having that conversation and showing them numbers based on how the software is looking at it, we do have the ability to show them some options there, and we can run analysis for that for sure.
So we do not want to forget that Tax Cuts and Jobs Act is going to expire here in 2026. So Richard, how might that change any Roth conversion strategy?
Yeah, Luann, and it's not just Roth conversions, but every aspect of your financial plan that we want to help you with, there is going to require some flexibility, right? Some years the market's going to outperform, some years it's going to underperform. And so we do want to keep some flexibility in any plan. But especially with the Roth conversion, we know what tax laws are going to be in 2024 and in 2025. But to your point, Luann, that the tax laws that were passed under the Trump administration, they are set to sunset in 2025. And if that does happen and the tax code reverts to what it was when President Obama was in office, we are going to see either less, or we are going to see people doing less Roth conversions. And the real reason is you're going to be bumped up into a higher income tax bracket. And therefore, all other things being equal, we're either going to have better market returns, or we have to plan on that individual living longer to get the same benefit of doing the Roth conversion.
Very good.
Yeah. And if you look at just to kind of, dovetail off what Richard just said, when because it's not a matter of if nothing's done, we know that they're going to revert back. What's really wild to me is, so here's kind of what happens at the end of 2025, the 12 becomes the 15, the 22 becomes the 25, and the 24 becomes the 28. Now, if you look at it from just a percentage tax increase, when the 12 becomes the 15, that's a 25% increase. When the 22 becomes the 25, it's a 14% increase. And when we're looking at the 24 become the 28, we're looking at a 17% increase in tax. So a lot of times when you hear politicians go, well, we're not going to raise taxes on anybody making less than $400,000. Well, I can promise you that if nothing's done, that kind of that middle America is going to get hammered because they are going to pay more in taxes than what they're paying today.
So, all right, optimizing tax outcomes, obviously requires careful planning. That's what we're saying. If you need some guidance, get a second set of eyes, especially if you have a substantial assets in your IRAs and your 401ks. Typically people allow these funds to grow tax deferred, delaying distributions and the payments of taxes. But why might this not be the best approach given individual circumstances, Chris?
Yeah. So I think you have to kind of look at it. And some of this is kind of, I think we've called it crystal balling on the air before. I think I was looking over at Graham when I was trying to think of the term.
I think that's the term.
I think that came from Kelly Myers, by the way, the tax guy that we've had on the show several times. Yeah. But anyway, so the thought process is while you're working, you're probably going to be in a higher bracket than when you're retired. And truthfully, and I've heard arguments either way. I've heard people say, oh, it's not the case. For most people, you probably will be in a lower tax bracket. I mean, if you're making together, married, filing jointly, say you're making $300,000 a year, the chances of you having a $300,000 a year retirement income, like normal income, is probably not likely. So in those cases, then I think it makes sense to start looking at a little bit more pre-tax dollars today, because you're getting the benefit of lower taxes today. and you're going to go into retirement in a, probably a lower bracket. And at that point, then you could start Roth converting. Here's where I think it doesn't make sense. So I've talked to several people here in the past couple of weeks, and based on their expenses and what they're planning to spend in retirement and looking at their income situation, I've seen situations where they were putting in Roth and they really should have just been doing pre-taxed money, because they can pull out a pretty decent little chunk in retirement tax-free because they only have Social Security income. So, matter of fact, I can tell you one of my more recent prospects that joined our firm as a client, this was because of this conversation. They've been to see multiple different advisors. And I just asked him, I said, why are you doing this? And he said, well, I want to have Roth money in retirement. And so I broke it down, very simple. And I said, let's just remove the retirement assets for a second. And let's just talk about your expenses and your income in retirement. So we looked at his expenses. We're looking at about $5,000 a month in monthly expenses. I'm looking at both of their Social Security incomes, and they're north of that. So if they, I think they were close to $5,800 in total Social Security income. So if you have income of Social Security of $5,800, you have expenses of $5,000, you're covering it, right? You don't need any additional money at that point. So I just looked at him and I said, do you know the tax bracket you're going to be in? He said, oh, yeah, I'll probably easily be in the 12 and probably creeping into the 22 at some point. And I said, you know what? You're almost right under normal circumstances, but the way Social Security is taxed, and being that it's your only source of income, you're actually going to be in a zero bracket. And he just looked at me kind of dumbfounded. And I said, now what this means is you can now pull out of your IRA somewhere, and I kind of give him a ballpark because I didn't run my software to kind of give him a pretty good solid answer. I said, you're going to be able to pull out about $20,000 out of your IRA without any federal tax. So you've got, $5,800 coming in, and now you can pull out an additional $20,000 without federal tax. And hey, by the way, did you know that here in Alabama, you guys are above 65 years old at this point, that, this year you can actually take $12,000 per person out of your IRA without any state tax as well. So you're in a zero bracket all the way around. So I'm asking you the question, why are you doing Roth today when you can put it in pre-tax and get the benefit today, and then you're going to be able to pull out a pretty good chunk without any tax obligation in retirement based on your income? So when I had that conversation and I kind of drew some things on the board, because I'm very visual myself. I love to see things written on the board. And when I go and I started putting these numbers on the board and started showing him how money's going to flow out, I mean, it was just eye-opening. And that's when we look at the way that we do planning, Luann, we definitely look at it from a tax obligation standpoint. Like, where's the most efficient way that we can pull money? What's the most efficient way we can pull money out of portfolios? That's one of the first things we're going to look at. That's why, and I don't want to beat the drum because we're almost at the end of the show, but that's why we consider Social Security a very, very important tax decision, because this individual, because of where he and his wife are at, they're going to have access to money coming out of their IRA, where normally if I ask this question in front of 100 people, they would say, oh, you're going to pay taxes. Well, in their case, they're not going to have to pay taxes on a certain amount because that's the way the tax code is. So it does pay to work with advisors that pay attention to this. I feel like that's where we excel. If you would like to set up a discovery session, you can give us a call, 256-937-2010. Again, our number is 256-937-2010. Luann, I appreciate you being here as always. It's good to be back. Graham, Richard, appreciate you being on the show and all your input. Appreciate all the listeners. I hope everybody has an awesome and blessed week. And remember to serve every person in every situation with a servant heart.
Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.
Investment advisory products and services made available through AE Wealth Management, LLC, a registered investment advisor. Insurance products are offered through the insurance business WG Insurance Services. WG Financial Group is an investment advisory practice that offers products and services through AE Wealth Management, LLC, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by WG Insurance Services are not subject to investment advisory requirements. AEWM and WG Insurance Services are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. WG Financial Group is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by WG Financial Group. This radio show is a paid placement.